Have you ever had a moment when everything seemed too good to be true? Maybe you landed a great job, your relationships were thriving, and life was just smooth sailing. Then suddenly, out of nowhere, things took a turn. A setback at work, an unexpected bill, or a personal challenge. It happens to all of us. And right now, the stock market feels like it's in that too good to be true phase. Stocks have been soaring, especially the Magnificent Seven, those massive companies like Apple, Amazon, and Tesla. Their growth has been nothing short of extraordinary. But the real question is, can this last forever? Or are we heading straight toward a painful market correction, just like history has shown us time and time again? 1. The stock market's wild ride. Why it feels like a never-ending party. Imagine you walk into a casino and you see someone winning over and over again. They throw down a bet and the dice just keep landing in their favor. They're raking in the chips, the crowd is cheering, and it seems like they can't lose. But deep down, you know how gambling works. The house always wins eventually. That's exactly what the stock market looks like right now. The past decade has been nothing short of a jackpot for investors, especially those holding stocks in the biggest companies: Alphabet, Amazon, Microsoft, Apple, Nvidia, Meta, and Tesla. These 7 giants have been driving the market to new heights. Their stock prices have skyrocketed, and their businesses have grown at an incredible pace. Let's take Nvidia, for example. A decade ago, this company wasn't much of a household name. Now, it's at the center of the AI revolution, and its stock price has exploded. And it's not just hype. Nvidia's revenue has surged from just a few billion to over $100 billion. Similar stories can be told for Tesla, Meta, and Apple. So, with all this growth, what's the problem? The issue isn't what's happening today, it's what could happen next. Because if history has taught us anything, it's that markets move in cycles. And right now, we may be closer to the peak of the roller coaster than we realize. 2. What goes up must come down. The hidden warning signs. Think back to the late 90s, when the internet was exploding onto the scene. Investors were ecstatic. .com stocks were soaring. New tech startups were popping up everywhere, and people truly believed the world had changed forever. And you know what? They were right. The internet did change everything. But that didn't stop the .com bubble from bursting and wiping out trillions in market value. The same thing happened in the 1920s, just before the Great Depression. The economy was booming. New technology like automobiles was transforming the world, and stock prices were climbing higher than ever. Then, in 1929, the market collapsed, and people lost everything. Right now, a similar pattern is unfolding. AI is the new big thing, and it's everywhere. It's changing industries, creating new possibilities, and making investors believe that this time is different. But is it really? Because if history tells us anything, it's that bubbles always burst, no matter how revolutionary the technology is. 3. Are stocks overpriced? The silent trap. Most investors don't see. Let's say you're shopping for a car. You find the perfect one. It's sleek, powerful, and packed with features. But then you see the price tag, 4 times what it cost just a few years ago. Would you still buy it? That's the situation with the stock market today. 10 years ago, legendary investor Warren Buffett was buying Apple when its stock was cheap and its future was bright. Back then, its price-to-earnings ratio, a key measure of whether a stock is overvalued, was around 10. Today, Apple is still a great company, but its P/E ratio is over 40. That means investors today are paying 4 times more for the same company, while its future growth potential is actually lower than it was back then. And it's not just Apple. Nvidia, one of the hottest stocks of the decade, had a P/E ratio of 18 a decade ago. Now, it's 52. That means investors are paying 3 times more for every dollar of profit than they did before. So what does this mean? It means that even though these companies are amazing, their stocks may not be as good of a deal as they seem. The market is in a phase where investors are willing to pay anything for stocks, ignoring fundamental value. And when that happens, history shows us that a correction is usually just around the corner. So, what's next? This doesn't mean you should panic and sell all your stocks, but it does mean that it's time to be smart, to think carefully, to understand that every market cycle has ups and downs, and the more we prepare for the inevitable correction, the better off we'll be. And here's the thing. The most successful investors aren't the ones who panic when the market drops. They're the ones who stay calm, think long-term, and make smart moves when others are fearful. So, what should you do next? Should you change your strategy? Should you wait on the sidelines? Or is there a way to navigate this unpredictable market without getting burned? We'll dive into that in the next section, where we'll explore how the rise of index funds is fueling this market frenzy and what it means for your investments. Stay tuned, because this might just change the way you think about investing forever. So now we know the stock market has been on an incredible run, with big tech stocks skyrocketing and investors willing to pay any price for shares. But here's a question that nobody seems to be asking. Why is this happening? Why are stock prices still climbing, even when some of these companies aren't growing as fast as they used to? Why are investors ignoring warning signs that stocks might be overpriced? And most importantly, what could cause this whole market boom to unravel? Well, the answer lies in something that has completely changed the way people invest over the past few decades: index funds. The silent force driving stock prices higher. Imagine if every time you went grocery shopping, instead of picking out your own food, you just told the cashier, "Give me a little bit of everything in the store." No matter how good or bad the products were, you'd get a small portion of everything. That's basically how index funds work. An index fund is an investment that automatically buys a tiny piece of every stock in a particular market, like the S&P 500. Instead of trying to pick individual winners and losers, investors just buy everything. And the result? More and more money keeps pouring into the biggest companies, whether or not their stock prices make sense. Decades ago, people invested differently. They would study companies, read financial reports, and decide if a stock was actually a good deal before buying. But now, more than half of all investors just blindly follow the indexes. If money flows into an index fund, it automatically buys more shares of the biggest companies, pushing stock prices even higher, regardless of their true value. And this creates a dangerous cycle. The higher stock prices go, the more people want to invest. And the more people invest, the more these stocks get bought, sending prices even higher. At some point, stock prices become completely disconnected from reality, and when that happens, all it takes is one small shock to send everything tumbling down. 5. Are we headed for a repeat of the past? Let's take a quick trip back in time to Japan in the late 1980s. At that time, Japan's economy was on fire. The world was in awe of its booming businesses, cutting-edge technology, and incredible stock market growth. Companies like Toyota, Sony, and Mitsubishi were global giants, and 8 of the world's largest banks were Japanese. The stock market just kept going up. Investors believed Japan's economy was unstoppable, and prices rose to insane levels. People thought, this time is different. Japan will dominate the world. But then, reality hit. From 1989 to 2003, Japan's stock market collapsed by 80%. It wasn't a fast crash like the 2008 financial crisis. It was a slow, painful decline that dragged on for over a decade. In fact, it took 36 years for Japan's stock market to finally recover to its previous peak. That's right. An entire generation of investors never saw their money recover. And if that could happen in Japan, the second largest economy in the world at the time, why couldn't it happen in the U.S.? We've already seen something similar before. In the U.S., stock market crashes have led to what's called a lost decade, a period where stocks don't grow for 10 years or more. After the Great Depression, it took 27 years for stocks to recover. After the dot-com bubble, it took 15 years. Could we be heading for another lost decade? The scary thing is, all the signs are pointing in that direction. 6. The trap that most investors don't see coming. Now let's bring this back to you. You might be wondering, okay, but what does this mean for me? Should I sell everything and run? The answer isn't that simple. The problem isn't index funds themselves. Index investing is actually one of the smartest ways to build wealth over the long term. Even legendary investor Warren Buffett recommends them. But here's the catch. Index funds work best when stock prices reflect true value. When the market is healthy, index funds help investors build wealth steadily over time. But when prices get inflated and detached from reality, like they are today, index funds can make market crashes even worse. Why? Because when the market eventually turns, everyone will start selling at the same time. And since index funds don't pick individual stocks, they'll just start dumping everything. It's like a crowded movie theater when someone yells, "Fire!" Everyone rushes for the exit at once, and chaos follows. The reality is, when the market is in a bubble, the people who blindly follow the crowd often get burned the worst. So, what happens next? If history is any guide, this stock market boom won't last forever. At some point, something will trigger a shift. Maybe it's rising interest rates, a slowdown in corporate profits, or even a sudden panic that spreads like wildfire. The real question is, will you be prepared when that happens? Some people believe the next market crash is inevitable. Others think it won't happen at all, because something big is about to change. And that leads us to the next piece of the puzzle, the role of government and how major policy shifts in 2025 could shape the future of the stock market. Will new policies fuel another bull run, or are we just delaying the inevitable? Let's dive into that next. So now, we understand why stock prices have been soaring. It's not just that companies like Apple, Tesla, and Nvidia are growing. It's that billions of dollars are being funneled into the market automatically through index funds, pushing stock prices up whether they deserve it or not. And, as we saw with Japan in the 80s and previous U.S. market bubbles, when stock prices get too detached from reality, a painful correction usually follows. But here's where things get interesting. Because there's one thing that could delay this crash, or even change the entire direction of the market. And that's government policy. Big changes are coming in 2025. and they could have a massive impact on stocks. Some people believe these changes will save the market, while others think they're just adding fuel to the fire. So, the big question is, will new government policies keep this bull market running, or are we just setting up for an even bigger crash down the road? 7. The new administration's plan, a game changer or just a band-aid? If there's one thing we know about the U.S. stock market, it's that government policies matter. Think about it. Just a few words from the Federal Reserve about interest rates can send stocks flying or crashing in a single day. A new tax law can change corporate profits overnight. And a shift in economic policy can either fuel a bull market or trigger a major slowdown. And in 2025, one of the biggest changes will be happening: a new presidential administration. Many believe that this administration is the most pro-growth, pro-business government the U.S. has seen in years. And if there's one thing investors love, it's policies that boost businesses and keep the economy strong. But what exactly is this administration planning? And how could it impact the stock market? Let's break it down. 8. The 4 big policy changes that could shake up the market. There are 4 major economic policies that could have a direct impact on the stock market in 2025. 1. The push for government efficiency. Right now, the U.S. government is running at a massive deficit. Interest payments on the national debt are climbing higher every month, and many economists warn that if spending isn't controlled, the country is headed for financial trouble. To tackle this, the new administration has introduced a plan to cut wasteful government spending. They're calling it the Department of Government Efficiency, DOGE, a move that aims to trim unnecessary costs and reduce the national debt. But here's the big question. Will cutting government spending actually help the economy, or could it slow things down? On one hand, if the government spends less, it might reduce inflation and create a more stable economy. But on the other hand, cutting spending too aggressively could lead to job losses and slower economic growth, both of which could hurt the stock market. This is where things get tricky. Because while investors like the idea of a more efficient government, they hate uncertainty. And if these budget cuts don't go as planned, they could actually trigger more panic in the market. 2. Tax cuts. A gift for businesses, but at what cost? Another major change in 2025 is the push for lower taxes on businesses. During the last administration, corporate taxes were slashed from 35% to 21%, which led to a massive boom in stock prices. Now, the goal is to cut them even further to 15%. In theory, this is great news for companies. Lower taxes mean higher profits, which usually leads to higher stock prices. But here's the problem. Cutting taxes also means less money for the government. And unless that lost revenue is replaced by something else, it could add to the growing national debt. So while these tax cuts might extend the bull market, they could also be creating a longer-term risk if the government struggles to balance its budget. 3. New tariffs. A hidden risk for the economy? If there's one thing we've learned from the past few years, it's that trade policies matter. And in 2025, the new administration is introducing higher tariffs, which are basically taxes on imported goods. The plan includes a 25% tariff on all Mexican and Canadian products, a 10% tariff on Chinese goods. The goal is to bring more manufacturing back to the U.S. and protect American jobs. But here's where things get complicated. Tariffs also make products more expensive for consumers. If companies have to pay more for materials and products, they might raise prices, which could lead to higher inflation. And if inflation rises, the Federal Reserve might have to increase interest rates, which could hurt stocks. So while tariffs sound great for the economy on the surface, they could actually backfire if they end up driving up costs and slowing down consumer spending. 4. Deregulation, boosting business or ignoring risks. The final major policy shift in 2025 is deregulation, which means cutting government rules that restrict businesses. Many argue that too much regulation slows down innovation. Take Elon Musk's example. At one point, government regulators wouldn't let SpaceX launch a rocket because they were worried it might hit a shark somewhere in the ocean. While safety is important, overregulation can create unnecessary roadblocks that slow down businesses. By cutting regulations, businesses could have more room to grow, which could fuel another stock market rally. But the downside: too little regulation can also lead to reckless risk-taking, something that contributed to the 2008 financial crisis. So the real question is, will deregulation help businesses thrive, or could it create a bubble that eventually bursts? 9. The market's big question. Can the bull market keep going? With all these policies coming into play, investors are divided. Some believe that lower taxes, fewer regulations, and government efficiency will fuel another major stock market boom. Investment banks are already predicting another 10 to 25% growth in the next year. Others, however, believe that this is just delaying the inevitable, and that we're still on track for a major correction. And history tells us that every bull market eventually ends. The only question is when. 10. So, what should you do? The stock market is unpredictable. Nobody can time it perfectly. Even some of the smartest investors in the world have gotten it wrong. Take Michael Burry, the investor who famously predicted the 2008 crash. In 2023, he tweeted just one word: S-E-L-L. But guess what? Since that tweet, the stock market has gone up 44%. Or Robert Kiyosaki, the author of Rich Dad, Poor Dad, who warned in 2020 that the biggest market crash in history was coming. Instead, stocks surged over 130%. The truth is, nobody knows exactly what will happen next. But the best investors don't focus on predicting the market. They focus on preparing for it. So as we head into 2025, ask yourself, are you investing smartly or just following the crowd? Are you ready for the possibility of a correction? Do you have a strategy for both good times and bad? Because while the market will always have ups and downs, the smartest investors are the ones who stay calm, think long-term, and make the right moves when others are panicking. No matter what happens next, the key is staying informed, staying prepared, and making smart decisions with your money.